All right, so the big reason that you were here, and the reason I'm here, well, the reason I'm here is because I'm here every month, and this is all I've got to do. It's on my calendar. But the reason you are here, of course, is to hear Braddock Cunningham. And Braddock, you're about ready, right? About ready for this bit? He says he's ready. So we have brought back one of our former speakers and one of our, actually our community partners as well. We've got Mark Kroll with StorageCraft, and Mark is going to introduce today's speaker. Can you do that?
If I use my notes.
You have notes. That's awesome. Can I hand you this microphone?
Am I allowed to ad-lib?
You may ad-lib. Try to get the name right, but after that, it's all you.
Right.
It's all you. Ladies and gentlemen, Mark Kroll.
Thank you. Please don't. So I get clapped because I'm going to read a piece of paper. I really appreciate that. Braddock Cunningham, serial entrepreneur, now having sold 3 successful businesses. He's featured in publications such as Entrepreneur Magazine, often presented at technology conferences across the country. He's a 2-time nominee of the Ernst & Young Entrepreneur of the Year, and his companies have been recognized 4 times as one of the 25 fastest growing companies in South Carolina. It gets better. He also sits on the board at the Julie Valentine Center, Greenville's Rape Crisis and Child Advocacy Center. Awesome, giving back to the community. He's a veteran of the U.S. Marine Corps. Thank you for your service, Braddock. Thank you for your service to the country and the community. He holds a BA from Furman and an MBA from Clemson. Now, I've had my bio read before I speak, and that's pretty flattering. This is awesome. Ladies and gentlemen, please help me welcome Braddock Cunningham.
Okay, that should be a lot better. Thought you were going to add lib on the bio.
Yeah, he didn't want me making jokes about Furman.
I can understand that. Although we just found over here, somebody's daughter just switched schools from Furman to Clemson. Now she needs to go to Carolina, and then she'll have all 3 covered. Oh, neither could I. Again, I'm Brad Cunningham. Glad to be here today and good to see all you guys. We're going to cover a part of a presentation that I do that's much, much longer that goes into a lot more detail. We're going to try to hit the highlights. And all of it's got to do with things you need to do inside your business to professionalize it, with the end goal being to exit that business. And I call it professionalizing a business. So it's things you need to do pretty much standard no matter what type of business it is, starting pretty much day one, that you need to put into place so you can have a successful exit. So kind of with that said, they kind of went over my stuff on me. Where I got this experience from and per se knowledge or whatever was definitely under fire. I have sold 3 companies, first one back in 2000 and then 2006 and then most recently in 2013. One of those sales was to a publicly traded company back in 2006, one to a private buyer and another one to another small business. So through all those processes of selling businesses, you go through a due diligence process many times, and you learn a tremendous amount of information by doing that. And I found a common thread through every process I went to that fit back to what I needed to be doing in my business the next time. So every time I tried to improve. So after I sold the first company, I said, okay, I need to do these things better. Sold the next one, I said, okay, I need to do all these better, because every question I kept getting when I would go through due diligence dealt with the same issues. So by the third one, I had it pretty much down pat and really followed a pattern, much of which is what we're going to talk about here briefly, with hopefully some few funny stories. Just a little bit more about me, don't need to worry about that. First thing, let me ask, how many people here actually own a business right now? How many entrepreneurs do we got? Okay. How many want to own your own business and to be an entrepreneur? Got a few over here? Okay. So somebody tell me what all in means. Does anybody know what all in means? Anybody? Somebody at this table? I can tell Max. I know Max can tell me. What's all in, Max?
Everything you got's on the table.
Everything you got's on the table. Most entrepreneurs are going to experience that. When you go and start a business, generally speaking, everything you got's in that business. You're probably in debt up to your eyeballs. Probably all your cash is tied up in it. Your entire net worth is tied up in that business. And I lived that life for pretty much 15 years. And over the course of that time, when you have that kind of risk on you and that kind of stress, the only thing you start thinking about is like, how can I get some of these chips off the table? How can I actually start to mitigate that risk a little bit and actually what I call realize some of that net worth? Because on paper, with one of my companies, I was worth a whole lot of money. I didn't have none of it. And the taxes I filled out every year looked like I made all kinds of money, but I didn't have that money because it was all tied up in the business. And that is a common problem that most entrepreneurs run into and you will face day to day. And it creates a tremendous amount of stress, and it creates a situation to where you try to look for how to get out from under that stress and actually how do I get a hold of that money. So through this process of professionalizing a business to get you to where you can exit and take some chips off the table is really the whole premise of why we're here. When do you start planning an exit of a business? Anybody? At the start, exactly. When you create a business, you should have at least in your mind some reason of why, or excuse me, not some reason, but some method of how you're going to exit that business. You know, you got to start putting things in place day one to make that a successful endeavor for you. Too many entrepreneurs get tied to their businesses from the perspective of basically like it's their little child. You know, that's my baby. And in that, they have difficulty letting go of that business. Now, you can love your business. You know, it's your idea, it's your sweat, it's your money. But at the end of the day, that needs to be its own entity. Just like your child. Your child has to eventually get out of the house, those of you that still have 30-year-olds living at home. You've got to get the child out of the house. So when I look at a business, of all the ones I've started as well as the ones I've acquired, going into it day one, I was looking at how do I let this business become its own entity where it can exist on its own without me, and I'm able to exit that business. So it sounds simple in some ways, but everybody here that started a business probably has been there where, you know, you don't want to hear anybody else's input, you know, that's your baby, and by doing so, you're actually crippling yourself for later on. Trending to maximize the value, how long? That's an important concept. What I mean by trending is, and this could change depending on who you talk to. This is based on my experience and based on the people that I've talked to over the years. If you're really looking at exiting your business and want to sell it to an acquirer, whether it's a private or institution or a public, you're going to be looking at a trending of 3 years. Almost every time I went through any kind of due diligence process or talked to investment bankers or whoever, they all wanted to see a 3-year trend. You know, 1 year is good. You know, you have a great 1 year, you know, you might think, I'm going to go try to sell this business off that 1 year. A lot of people are going to look at that 1 year and think it could be a fluke. It could be based on one big project you did. It could be whatever. 2 years, kind of the same thing. It still could be the result of a singularity that happened. Could be good accounting. 3 years, it's hard to do it over 3 years. So you want to focus on that 3 years. Reason I sold my last business when I did, because I had a tremendous number of people, including financial advisors, bankers, lawyers, everybody telling me, why are you selling that business? You know, you've been 4 times on the Stockline fastest growing list in the last 5 years. Why in the world would you sell this business? I said, well, I bought the business in 2008. Anybody remember what happened in late 08 and 09 and 10? Okay. I have beautiful timing. I started my first software company right when the dot-com bubble burst. So I've always had real good timing on that. I was looking at my numbers and looking at my trends after the recession we came out of it, and I'd had 3 just absolutely stellar years. 3 years of very trended growth, 3 years of expansion. We had opened up multiple offices. When I bought the company, we had 1 office in Greenville. When I sold, we have an office in Charlotte, Columbia, Anderson, and Greenville, and we had tripled the revenues in the course of 5 years. So when I'm looking at selling, I'm like, you know, if I wait till next year, you know, and just keep, because it's growing and everything, what if we have some downturn in the economy all of a sudden? What if, for some reason, my business goes through a situation where we have a competitor start taking some of our business? You know, it could be numerous things, and all of a sudden my business cuts down. I got to start over. I got to start building another 3 years, because you go talk to anybody about evaluating your business, and if they're looking at acquiring you, and you got a great year, also a crappy year, all they're going to see is the crappy year. So 3-year trending is very important. Know the primary areas to professionalize. So based on all these questions through these due diligence processes, and like I said, it felt more like an interrogation most of the time. Who in here has been through due diligence with an acquisition, with a sale? All right, so it can be a little confrontational at times, because again, that's your baby, and you're defending all your numbers, you're defending your company, you're defending why it's got a value, and the other side is basically trying to tear that down to some extent, because again, they want the best price for the company on their side as well as you want the best price. So when you go through the process, it's easy to get very defensive. So like I said, it's a difficult process. But the commonality I found were these 5 areas, that if I had these areas handled, and we'll talk about what handling is, in my business, the diligence process went smoother, and I actually got the maximum value for my business. So at financials, we'll give you a few stories about my last company on this too. When you start a business as an entrepreneur, it's real easy to do some really bad habits. So of those of you, there was quite a number here that said they've owned their own businesses and all. How many of you have used your personal credit card to pay for company stuff? Okay. When you did that, did you go back into your company books and set up an account to offset that, or did you just pay it and say, don't worry about it, it's mine? How many have used company funds to buy something for them personally? I don't see hands coming up, but I know it's happened. So I'm not the IRS here. Point being, it's easy to do because you're in charge of the checkbook. It's your company. You own it 100%, let's say. And again, like we said earlier, your company is your net worth. So it's easy to do. But when you get later on, you try to sell that business, you just created yourself a quagmire. And I'm not sure how many Marine Corps people we have in here, but quagmire is a really bad thing. So you've got to treat that company as a separate entity, like we said before, and financially, you've got to maintain integrity between no commingling of funds, no personal funds versus company funds. If you do that, now it's your company. You want to take money out, but do it the proper way. Create an account in the system, such as due from owner or due to owner, things like that, so that it balances out, and when you go to the diligence process, it all makes sense. So there's no reason you can't take money, but just do it the right way. When I bought Network Controls, my last business that I had, I knew, because I knew enough about the business during my own due diligence process when I acquired it, that there was going to be some cleanup to do, some financial cleanup. When I first went in and got a real look at everything and realized there was a real big discrepancy on the P&L statement from a year or so earlier than when I acquired it, to the tune of about $200,000 of money just kind of went away. Come to find out, the previous owner had purchased a M6 BMW and a Lamborghini with the company's money. Those were his cars. He titled them in his name, but the company purchased them. Now, I purchased a stock when I bought the business. It wasn't an asset purchase, and I did it for a variety of reasons. But since I purchased a stock, those books were mine even historically. So I'm looking at all of a sudden all this money that the company spent out, and there was no asset associated with it. So one of the first things I had to do was, I got with my CPA and we figured out what we needed to do, and we created a balance sheet item for that asset and marked it in as those cars were purchased because we showed that the company purchased them. And then I promptly 1099'd the previous owner for the entire balance. He was not happy. I mean, he just sold a business. He's all good. He's happy. He's, he's rolling around in money, carrying around in a briefcase, literally, didn't he? We got some people here know the guy. Great friend of mine, actually. But he was not happy when he got his 1099 for about $225,000. But it was what I had to do. I had to do that to clean up my books, because anybody that went through and audited my books going back, they would have found that discrepancy and like, what is that? So it took me about 2 years to what I consider clean up the financials in that business to get it to where I needed it. EBITDA. Another thing you need to be concerned about when you start looking at exiting a business, and hopefully most everybody here knows what that is, earnings before interest, taxes, depreciation, amortization. The EBITDA number is huge. And in most businesses, when you're talking to investment banking firms and such, and our potential acquirers, just so you know, they're looking for a number north of $1 million normally on your EBITDA, if you really want to get maximum value for your company. Another reason, when I did, I just maintained a very strong EBITDA number over the course of those 3 years. I didn't want that number to drop, so I sold. But you got to be really concerned with that EBITDA number and make sure it is a strong number if you actually want to sell the business. And again, my experience has been you want to be north of $1 million. I'm going to skip over some of this because, again, this is for a little bit longer thing. I want to talk about historical financials. Another thing that I've seen many businesses do is they will have maybe an accounting practitioner do their books, maybe just a bookkeeper do their books, and then to go and get their taxes done. And the taxes may be done by a CPA or whatever. But that's kind of the extent of their oversight on their financials. You're going to run into an extreme issue when you go to sell that business with that, because you have very unverified financials and they're going to dig in that with a fine-tooth comb. I highly recommend doing at least CPA reviews on your financials. You don't necessarily have to get them audited, but do a CPA review. And if you have that, the amount of leverage it gave me when I would talk to banks, so not just on an inquiring situation, but when I talk to banks for credit lines or purchases or whatever, when I would talk to bonding agencies, because in my previous businesses we had some bonding we had to do, or when I would talk to acquirers. When I would hand those CPA reviewed financials over the course of 5 years worth, it carried so much weight. And it eased that process and that examination into my books tremendously. I mean, just eased it way down. And I've been doing CPA reviewed financials with all my businesses since 2000. So even, as small as $1.2 million business to as big as $16 million business, I still did that because it makes such a tremendous improvement when you get ready to really sell that business or try to do anything, try to get a bank loan. It helps a lot, so I highly, highly recommend that. Transparency. Talking about the commingling of funds earlier, to take that one step further, you want your books, let's just say squeaky clean. I mean, you want transparency. I had no problem sharing my numbers with my senior management in my last company. Again, I was treating that company as its own entity. It should stand on its own. I wasn't hiding my numbers from anybody, and that's not a good habit, even as an entrepreneur in a small business. If you're so concerned about your numbers, you're not willing to share it with your top other management people or to have businesses, or even with the overall employees, discuss how the business is doing, then there's something not right. You should be proud of those numbers. You should be proud of what you're doing. And it should be open, and it should be auditable, and you should be transparent with those numbers. If you do that, again, when you get down the road to sell that business, you're going to find the process so much simpler, and you're going to get maximum value for your business. Organizational structure. This is another thing I see the entrepreneurs do tremendously wrong. And to go back to my most recent business that I acquired, I have something called an upside-down T as an organizational structure that I see tremendously in entrepreneurial companies. So imagine a T, but upside down. And what that means is basically you have the entrepreneur, the owner, the CEO. Maybe he's got some other manager, and then he's got all the worker bees. That's it. When I bought Network Controls, they had president, CEO, same gentleman. He had one operations manager, and then they had all the technicians spread out. Didn't have a separate arm really for marketing, didn't have really a separate arm for handling even administration. He just had, it was very, very top heavy. To the extent, this was a $5.4 million business when I purchased it. Every single purchase order for this company was reviewed by the CEO every Thursday. Literally, you'd be in his office, there'd be a stack of purchase orders that high, set on his desk. He put his initial on every single purchase order. How can you scale that business? How can you grow a business like that? If you don't have enough trust in your people and your management, and you don't have the right processes and procedures in place to not have to sign off on $14 for toilet paper, you got an issue. So one of the first things I do when I come in as part of what my strategy is I want to build an organization that runs itself. You still put checks and balances in. His excuse for signing every PO was, I also make sure our project managers aren't stealing. I want to make sure we're not buying too much material on projects. Well, you can do all that through reports and processes. You run a job. In my last company, we were job centric. We did projects and jobs, which is pretty much applicable. Even a software company, it's still projects and jobs. You can run the P&L for every individual job, and you look at it. If the job's losing money or not hitting the goals that was set up, then you delve into that one and you handle it. But you've got to trust your people and you've got to delegate, and you can't be the guy sitting up there doing everything, which is what I'm talking about. You also can't have that person either, even if it's not you. Another thing I've ran into in a lot of smaller businesses especially, heck, even up to $10 million, is there's always the guy or gal, the one that can do everything, can code, can sell, can market, can do admin, even can do finances. That's not good. It may sound good, but that's not good. Because when you go again to sell, and again, that's what we're trying to get towards, selling so you can get your chips off the table. If that person is you, it's really, really bad, because who's going to want to buy your business if you're the one doing everything? The business won't exist without you. If you still have that one person that is also doing all that, they're going to be very concerned about coming in and acquiring that business, because what if that person leaves? Oh, I got them under a non-compete. Okay. I don't want to go there for anybody. Anybody who's owned businesses knows how useless to a certain extent non-competes are. They're to keep honest people honest, just like locks on doors. So you don't want to do it. You won't have a structure in place with processes. You want to have whatever it is, your administration area, you won't have a truly defined administration area that has their processes. You won't have a sales team, whether it's one person, but you want to have that sales guy. Now, I'm not saying day one in your new entrepreneurial startup that you go and hire all these people. It's a process. That's what you're going for, though. You want to build into that. You want to build into a true sales team, a true finance team, a true marketing team, your operations. You want to build into that so that you can basically take a step back from that business and it's still running. And if you can do that, that's when you can truly go to the market and sell that business. And it's going to be a very attractive business at that point in time. And the reason we want that business attractive is so we can get that higher multiple. So, not saying you can't sell a business that doesn't fit these requirements, but you're not going to get top value for it. Legal issues, another area that you got to spend time working on, and like I say, hopefully the lack thereof. But if anybody's been in business for a number of years or ran businesses even in excess of $10 million or even under, if you've not had a legal issue, then count yourself lucky, because it's going to happen. Something's going to happen. Maybe you get sued by somebody. Maybe you get a contract that you got into that you don't like and you end up suing them. Maybe it's over placing as little things as placing liens to get accounts receivables in. Maybe it's a labor audit. There's so many different things that you are exposed to as the owner of the business that could happen. So it is extremely important to try to run your legal sector of your business very clean and forthright, full disclosure. Be sure to have all your licensing in place, your HR protocols and programs. I'm not saying you gotta go hire an HR manager. If you're a small business, maybe you don't need that. Maybe you can have your office manager do it as well as maybe your ops manager. But what you can do is bring in an HR consultant to make sure you guys are doing it right. Make sure your hiring procedures are correct. Make sure your termination procedures are correct. Make sure you're not doing anything discriminatory. Even though you don't think you are, trust me, you come in, they look at what you're really doing as far as job requirements, job descriptions, you can find issues in those things as well. So it doesn't cost that much money to bring an HR consultant in to make sure you're doing that stuff right. I can't stress that enough. It is so easy to get you in some serious trouble and to cost you money and to cost you momentum as a company. So take the time to do that. Develop a good relationship with a lawyer. Don't just use I know everybody, they cost money every time I call them. True story. Well, not necessarily. Not if you buy them bourbon and cigars. Sometimes mine haven't cost me as much when I do that. But you want a relationship with a lawyer not just when you need them. You don't want to just every time you call them up, you got an issue. You want your attorney to know your business. You want your business attorney to really know what's going on in your business. Take them to lunch, invite them over, invite your attorney to meetings. You'll be surprised how often they will come. Start running things through them that maybe you think you can handle yourself, such as just supplier contracts and such. Go ahead and take the time to meet with your attorney, spend the $300 and do it, because developing that relationship is going to pay you dividends 3, 4, 5 years down the road. You want people to know your business. I want my banker to know my business. I want my lawyer to know my business. I want my CPA to know my business. I want all of them to be intricately involved and knowledgeable of what I do. Because when it comes time, taking us full back to due diligence again and going through that process, if I've got those 3 or 4 folks in my pocket, so to speak, of knowing that, you know, they know how I do business, they know I'm transparent, they know I do full disclosure, they also understand my business, they are going to totally have your back going through that process. And again, that will result in increasing your value of your business. Marketplace and industry. This one's a little different. It's not so much a thing you need to put in place in your business to scale it and to grow it and to sell it, but it's something for your own education to prepare you when you get to that due diligence process. As the CEO, as the entrepreneur, as the owner, you need to be very well aware of what's going on in your industry. You need to know who your competitors are. You need to know what size your competitors are. You need to know where you fit in terms of that market. You need to know what the real exposure is as far as the risk factors to your business. You know, I've heard many entrepreneurs speak before and tell stories about, I got the perfect business, it's recession proof, it's this, it's whatever. No, it's not. There is some risk associated with that business, which is why I say do an old school SWOT analysis. A lot of people think, you're not in school anymore, you don't do it. Do it. Strengths, weaknesses, opportunities, threats. Do that. Make your management team do that. You'll be surprised. They'll see stuff you won't. Because the more in tune with that information you are, when you go through the process of talking with the due diligence folks, they're going to ask you these questions and you're going to be able to answer them. You're going to be able to tell them, this is why the business is where it is. Yes, those are potential risks, but these are the things we're doing to counter that. When on network controls, one of the major things we ended up being, I didn't really talk about that business that much. I'll regress and just say, when I originally purchased it, it was an electrical contracting business. 75% of the revenues came from electrical contracting. About 20-25% came from what's called structured cabling. I had really no desire to own an electrical contracting business. So over the first 3 years of owning the company, I did a joint venture with another gentleman that allowed me to basically slide over the electrical contracting business into another company, while at the same time allowing me to grow the technology side. So it was very proud to say it was very successful. Over the course of those 3 years I did that joint venture, at the end of the 3rd year we were doing 0 electrical contracting and we had increased revenues by $3 million. So it worked out really well. But once we became a technology company, structured cabling was a huge piece of what we did, in addition to any other kind of technology infrastructure. So just kind of know what the company was. So when I went to sell it, since we did structured cabling, I got asked this question multiple times by many different potential acquirers. Well, what do you think of wireless? Wireless is going to kill this business. Wireless is going to kill this business. Again, people, and luckily we got some nerds, good technology people in here. Stole that from me, Phil, sorry. That understand this more so than these people trying to acquire my business did. Wireless does not mean wireless. You still got to have wire. You still got to have fiber. You still got to have a backbone. If anything, the more wireless coverage you provide, which at the time I was selling network, the biggest thing we're doing these big umbrellas of wireless at college campuses, industrial zones, even the port authorities, where you come and just have this big umbrella wireless to offer things from RFID and general Wi-Fi access for people. The more you do that, the more cable you actually need, because you still got to provide the backbone for that wireless. So we did a big project for Anderson University, and we were putting in one of those umbrellas, wireless umbrellas for their dorms. We had to run no less than 3 miles in total. It's not 3 miles linear, 3 miles of fiber optic cabling to make that happen. By understanding that in the industry and being able to talk to those people, I could answer those questions. But it was something I got asked all the time. So again, whatever business you're in, understand the risk, understand your exposure. Oh, be prepared with comps. We won't get too much in that. That's really a fun topic, actually, because you go ask 3 people to evaluate your business, you're going to get 3 totally different answers. And they're going to tell you they're using whatever number 1A method to do it and all that, but you're going to get 3 different answers. Really and truly, what's the business worth is what you can prove it's worth yourself. And one of the ways you can do that is by doing comps. And that directly affects your multipliers. And you can go out and find some kind of like type business that has sold successfully. It doesn't matter if it was even a big business, if it's maybe a whole lot bigger than yours, whatever. it still gives you some amount of a trend to show you what's possible and where the business is going, and what multipliers kind of common out there. But you need to understand what those valuations are. And different businesses in different industries have completely different multipliers. I mean, I went from a software company to where the multiplier was so crazy in terms of profits didn't have to be that big, and you could still sell for a really big number because it was technology related. Then I went to an operating company doing structured cabling, and all the multiplier came way down, came to 3 times. So there we had to really have high profits to get to where I wanted to go. So, but just understand comps, and you can do the research. There's plenty of opportunities and research places out there that you can go to find out that information online. Also talk to investment bankers. Make good friends with those guys. They can help you tremendously in that. And kind of the last thing to talk about before I open up for a few questions, motivation. Why are you selling? Why are you seeking capital investment if you're doing that? And what is your plan post-exit? It's kind of funny, you ask that all the time. I mean, to me it should be self-evident. Why am I selling? I want to sell so I can, maximize money and get my net worth, But everybody that I have ever met with asked me the same question. Why are you selling? It's almost like they think, and maybe I understand this from a psychological standpoint, it's almost like they think the business must be booby-trapped or something. So that's the reason you're trying to get out, especially if it's doing good. You're showing, you went from 5 to 8 to 11 to 12 to 15 to 16 million. Oh my God, it must be fixing to collapse. No, it's just the right time to sell. But you have to be able to articulate why you're selling. And one of the biggest things for me, and if you've not thought through this or not, you will at some point as an entrepreneur. And if you've been doing this a while, you have already experienced this. And it's something called operational risk. No matter how successful your business is being, if you're like me, you're going home at night still having difficulty sleeping sometimes, because anything could happen tomorrow. Anything could happen tomorrow. You're selling the best widget in the world, and it's selling gangbusters, and Walmart's selling it, and it's selling on, online, and you wake up next morning and read the front page article, and somebody with a whole lot bigger budget than you, a whole lot deeper pockets, and a wider stretch has just put out a better widget. You're screwed overnight. That could happen. You're running the business, one day you walk in and some crazy things happen, or you're getting sued. Maybe one of your employees knocked over something on a job site and somebody fell in a ditch and died. Happens. I was at Piedmont Natural Gas when that exactly happened. A guy got knocked into a ditch and died. So anything can happen. And I call that operational risk. And every day you're running that business, I feel like I'm also on that tightrope. I'm like, okay, good. Whew, today was successful. Or I finished that year, got that year done, that was successful. At some point in time, that weighs on people, and everybody's different. My tolerance seems to be around 5-6 years, because out of 3 businesses now, each of them have went 5-6 years. So some people can do it 20 years, and that's awesome. But my operational risk grows and grows and grows as I'm building, and it gets to the point to where that's a huge part of my motivating factor. The other motivation is, and it's okay some people also feel that they shouldn't say this when they're talking to a potential acquirer. To be honest, say, well, I want to get my money out of the company. It's like, we don't want to say that. We don't want to say we want to make money. No, that's part of it. I want to get my chips off the table. The stress of being all in, as we talked about to start with, can weigh on you so much in your family and your life. The sleepless nights, the times you've went without paychecks that you remember, and you would like to get that money. That's a valid reason. Don't be afraid to tell them. It's time. I want to realize my net worth and go on to wherever the next phase is. What's your plan post-exit? Now here's a good one. So you're going to sell a business. They're going to, maybe nobody's going to ask you this except for your friends and advisors, but they're going to say, what are you going to do afterwards? I think everybody, thinks in some ways I'm going to go live on an island in Tahiti, or, I'm going to retire, or I'm going to do whatever. Let me paint you some scenarios for those who have not exited the business yet. It's not all roses and cherries, okay? It's not all money dripping out of your pants all the time. Although you do have enough people asking you for that, that. If you make, let's just use round numbers, let's say you make $3 million on a sale, you get $3 million. What's the first thing you want to do with it? You're probably going to try to invest that, put it back so it can continue to grow and stuff. You put that $3 million, in an investment portfolio. theoretically, you really can't touch that money. You know, depending on what you put it in, you actually really can't. But, you know, you don't want to go and liquidate securities all the time. So you've got that money over there. Maybe you kept a little bit out with to play with and all. And maybe you've had some fun and rewarded yourself in some ways and done this or done that and everything. Well, every day you get up, you're using that money to live. And you don't have an income. So a lot of people, when they do this, they don't think forward. What am I going to do after this for income? Otherwise, you're still living off the money you made and you sold that business. So you've always got to think through that, because money can go away really, really quick. So a lot of people have exited businesses. I know that so I have a couple of people that I know that sold for around 2 to 4 million, and half of it was gone within 5 years. You know, you've got to think, how am I going to make a living? How am I going to pay my normal bills? If you're looking to sell a business at such a rate that, you know, the interest off of it makes it for you, that's awesome. But unfortunately, the interest thing, I think Wells is giving me 0.06 right now. I remember the first bank statement I got after making a big deposit in the bank post-sale, and I was expecting that statement to come, and I was going to see this thousands and thousands of dollars in interest, and it was like $68. And I'm like, okay, time to put it in securities, which then you're flowing around with the market and you know, the ups and downs there, which I'm not going to talk about that right now because it's quite down. So I'm kind of reeling from that. So do think about it. I mean, when you're selling that business, you know, you might be getting excited about this big lump sum you're going to get, but you need to be thinking forward about, how am I going to make income? You know, what am I going to do? Is that going to be investment? You know, is there some things I'm going to put it in where it's going to give me a dividend? You know, am I going to work again? Am I going to start something else? You know, am I going to rehab houses, which is what I do? So you just got to think through that and have that answer for yourself, because trust me, when you sell it, you're still going to have a need to live, you know, and that money can go away, and you've worked too hard and too many years to make it. Well, that's a real quick version of this whole thing. I'll say I do this in a longer situation where I go through in depth on all these different professionalizing items and talk through the particular processes of doing them, and there's a few other little past stories I can share, but I want to open it up for questions, and if anybody's got any. Yes, sir.
So it certainly makes sense about why you exited the business, but can you give us a little color about how you went about it? Did potential acquirers approach you, or did you go to them? Did you go through a middle person? How did that
Great question. So just so everybody heard, the question was, what was the process for me actually getting to the point of being acquired? You know, how did they just come to me, or did I search them out, or what did I do? One of the things starting early on, and I did this with my previous company too. The first one I did not. My first one, I got called one day. I had done a speaking engagement in Chicago, and about 6 months later, I get a call one day from this guy at Atlanta named Jeff Twomey. We'll never forget the name. And he goes, "I'd like to sit down and talk to you about your business." Okay, whatever. Sat down, went to lunch, and offered to buy the business, and 3 months later we were done. So that's how that one went. So I thought it was easy. I said, this is nuts. I just got to get going, start a business, and it's all easy. The next two, I put a process in place. And the process at Network Controls, for instance, 3 years out from when I actually ultimately sold. So starting in 2011 probably, I started meeting almost quarterly. Literally, we probably were almost meeting on a quarterly basis with an investment banking firm here in town. And what we were doing, I would shoot them my numbers when I would close a quarter, send them my other information, and as far as I used to do a thing called CEO notes, which if you own a business and you're not doing that, you should. When you close out your year or close out your quarter, however you're doing it, my CEO remarks always dealt with the state of the company. You know, where are we at? What are we doing? And I broke it out into all the areas, the financial areas, marketing, future growth, those type. I mean, whatever makes sense for your business. But I would write that up. I was actually amazed, because I didn't do that with my previous business. I just started that with Network Controls. I was amazed how much that helped me through also in the due diligence process, because they went back and they were reading this. And they would see stuff where I would write about, you know, what our forecasts were, and then they could look at the numbers and say, oh, we did it. So they knew it gave validity to what I wrote. So I would send all that information to the investment bank firm. Then I would meet with them, and it would be several of their guys, their finance guy, their business broker guy, and the manager over there. And we would sit down and throw the numbers up on the screen and we would talk about the business, where we're at. I would talk to them about what they think my valuation would be, what things should I do different, what stuff should I clean up on my balance sheet, just whatever. We would talk through for about, I don't know, an hour. And starting in 11, we did that almost every quarter, and as we got closer to 13, it became apparent as we were having these discussions that the timing was getting right to actually sell the business. Because they started coming back to me with numbers that made a lot more sense to me in terms of valuation. The number in 11 didn't make sense. The number as we were getting into 13 did. So that process allowed me to also keep myself honest in terms of how I was managing the business and all. But yeah, I openly went out and talked to them. Then when it got time to sell, with Network Controls specifically, that same investment banking firm I talked to, I let them know that this is where we're going, this is what I'm going to do. I'm going to go ahead and officially give it to you guys to start finding acquirers. I also had some friends that owned another company in town that basically did investment banking, but very relationship driven. There was only two guys, and it was all their personal relationships of high net worth people they knew in companies. I let them know too, and they started bringing me potential acquirers over the course of about 6 months. Then out of the blue, the president of the company came to me one day and gave me a letter of intent. So all these people I've been talking to, which that's another part that I like to get into when we have a longer time, is all the various ways to exit and how to structure deals. There are so many different ways to structure a deal. This gentleman who bought Network Controls, he did not have the money, nowhere close. Not even a little bit, even enough for the down payment. But between a take-back note that I did, and he ended up getting the biggest SBA loan that's been done in South Carolina, which was awesome. But he got that. It took 9 months, but he was able to do it. So, and that's actually the first time I've ever heard the SBA working, in my personal experience. So it was good. So I openly went and searched for the guys myself and made them aware that this is where we're going. Anybody else? Yes, sir.
How transparent are you with your employees? And what are the conversations like?
Talking about like with financials?
Well, no, when you're looking to sell, like, are you involving them in that 3-year?
No. With actually the employee base, that's not shared at all on the exiting of the business. The only ones that I shared that with would have been senior managers. And in my case at Network, for instance, it was simply the president. He knew. Plus he also owned 11%. So I actually had an obligation to let him know what I was doing too. But the employee base, no. And that's pretty common. You don't want to do that because it creates so much angst, and people don't understand. You're talking about people that work a job that probably are great at their job, but they don't do what you do. They're not the CEO. They don't understand the nuances of that this is not going to impact them in their jobs. They're thinking, oh my God, he's going to sell this and that. And the same thing, so they're like, oh, the company must be doing terrible, this and that, whatever. So that is one thing that I'm not transparent about. Now, in terms of financials, I talked about this a little bit earlier, but with my senior team, I share everything. I always share complete financials. With the overall employee base, when we'd have like Christmas and stuff, I would always share kind of top line stuff. Let the employees know, this is how we've grown, this is how we haven't grown. We go back to like 10. These are what we forecast going forward. And I found I had many employees come to me and tell me just how thankful they were that I was doing it. Because I think most companies don't do that. But, if you're a public, you got to. So why, and again, I always, that's the one thing I've not done is IPO the company. I would really love to do that. But if it's required in a public company, wanting to truly run that business as its own entity, you need, that's why I did. I wanted to run that business the same way. So, anybody else? Yes, sir.
Almost everybody hits the landmine before the sale and another one after. What's the biggest ones you did before and after?
The biggest one after, when I sold eBridge Technologies, my software company, I took back a quite significant note as part of that sale, and the note was actually in the form of a stock pledge since it was a publicly traded company. They never honored the stock pledge. They paid interest on it. They paid interest on it for about 18 months, and then when it came time to mature, they just didn't do it. I had the signature of the CEO from a publicly traded company right on the stock pledge. I had all the contracts and everything. I spent quite a bit of money going after it, and it got to the point to where apparently they had enough power just to ignore it. And that sucked, because that was pretty much on that sale, it was half of the sale. So lesson learned when I sold this one, I only took back about 10% of the sale and did a much better job of contracts also, because that was the other thing. I found I did a poor job of really doing good contracts to protect my interests. Landmines going in to a situation would have been with network controls. As soon as the president found out I was going to sell the business, it changed his entire demeanor. It changed how he reacted to me. It's almost like I didn't matter. And as we were going through the process, again, he's the one who came to him with a letter of intent, he basically started acting like he owned the business. We've never even gotten to the closing table yet, but it became very difficult for me to manage the business at that point in time because of just how he got. And this made it very, very difficult over about the 6 months. Luckily, we got to the closing table and all, but it just, his entire personality changed. It's like he already owned it. So, anybody else? Yes, sir.
Any of the businesses you own, you mentioned he had 11% ownership. How far did ownership go in the business as far as you go down to the employee level or just upper management? How did you, I've had people tell me, further down you go, the more difficult it becomes when you're going to sell the business to kind of clean all that up or make sure it's clean.
Yeah, I would agree with that. It becomes very difficult. In this particular case, I started off with 2 minority owners in addition to myself when I bought Network. Had an 11%, and the guy who was already there, he was there before I bought it. He was already operations manager. And then I had another gentleman that had 25% that I ultimately bought out. So I was left with just me and this gentleman. And then I actually gifted him 4% more as goodwill when I purchased the company. So it got him up to 15%. I did not offer any more stock ownership to anybody else further down. When I had my technology company, eBridge, I went the route, and I think it was happening a lot in technology companies back then in the early 2000s, mid 2000s, where everybody should have a piece of it. Everybody should have a piece. So I worked out a plan there to where people could vest into and buy into ownership. And at least in my experience, it was a quagmire. It really did not work like I think it was supposed to. I had a lot of issues with employees feeling like they were more empowered than they were. They're still not the ones at risk. They're still not the ones signing for everything. So that one, if I had it to do over again, I would instead probably put together maybe some kind of bonus structure that would be tied to, when I sell, you're going to get something, but I wouldn't have actually done stock.
Well, yeah, because I like phantom stock, you hear about that, stuff like that. Even that gets more and more hairy as far as doing that. But if you want to, I always hear, employees say, hey, when you sell, you'll be fine, the rest of us will be, that kind of thing. And you kind of have to let some of that just be what it is.
Yeah.
But at the same time, I do want, they're helping contribute to the success of the company. So I do want them, and typically it's been bonuses that we do, but, I just kind of scared.
And I think that's more a thing with the technology companies where people almost expect what you're doing is building something to sell. I mean, it's kind of that expected. When you got a more established business, I don't think the idea of selling is in everybody's head that that's where we're headed. The bonus structures worked really well for me at Network. And I extended those all the way down to the lowest levels of management. And then we even bonused out to all employees based on profitability. And that was another thing I didn't cover, I'll say it briefly for anybody it may impact. I've been in multiple businesses now that do a very big mistake. They have different bonus programs or incentives for different people. Like, this guy over here, we got certain things going on for him. Or this gal over here, we got certain things going over here. When I bought Network, there was probably 10 different programs out there for people, and technically they were at the same levels, a lot of them. Don't do that. Don't do that. People talk. Okay? You may think you're being all whatever. I'm going to incentivize this person over here. And then, no, they're talking, and it's just going to create a quagmire. And that was one of the things that took me about 6 months to fix, to get everybody on the appropriate bonus program. Any last questions? Yes, sir.
With your last company, the reason for selling to an internal employee on a leverage deal versus external deal, was it timing? timing? Was it valuation? What was your?
Timing and valuation both. Timing was perfect because I had just started the process, was already meeting with potential acquirers, was going through multiple different sets of due diligence with different people. He came up and ready to do it, and supposedly showed me a means to do it with the SBA. He had a term sheet, the bank gave him, but we all know how, a term sheet is, but still. And the valuation was exactly what I was asking. So when you look at talking to outside people, and I'm going to fight for that valuation, I'm going to fight through their processes, plus he's an informed internal person. So I don't have to go through my financials with him. I don't have to go through the operations with him. He is completely informed on all that. So it made that a lot easier. It made that attractive, too.
Thank you very much.
Oh, one more question?
I just was gonna, you mentioned, I just want to know, you mentioned you do a longer talk. Is there something you do on a regular basis? Or?
Not on a regular basis. I'm done some seminars, and actually Phil will probably be putting some up about that when I get one of those going. Yes.
Just curious what happened to the businesses after you sold them. How are they doing? Are they
Network Controls is doing awesome, and that was already a 10-year-old business when I bought it. So it was an established business, a great reputation. They have condensed it some. He closed the Charlotte office, but it's still going good. eBridge Technologies, as is pretty common with software companies, the company that bought Janelle, when they bought it, all they cared about was the software. So within 18 months, eBridge was gone. All the employees were gone, everything. So they just cared about the software. Thank you, guys.